This is not a panacea to make you $1 million in 30 minutes. I want to make that very, very clear. It's like giving you a whole bunch of scalpels. You can go and cut yourselves to bits. It's another scalpel. If you get this stuff wrong, it will rip your account apart faster than anything else that you have come across. I just want to make that really clear. So one of the reasons I haven't gone down this path before is because it's an acquired taste, and they don't all work out as well as the examples we're probably going to look at this week. So if you just bear that in mind as we kind of progress, I would appreciate it. This is not a definitive course on options. If I was going to do a definitive course on options, I would need a week, a full week, every session for a week. This is going to be a look at what Gann did, what Gann said to do, and what I do. That doesn't mean it's correct or it's going to work for you. Options carry risk, just like futures or shares. We're going to look at directional strategies, which limits your risk to the premium you pay for the product, for the most part. Something like 95% of options expire worthless. They're a hedging product. So they actually have no value at the end. If you get the timing wrong, you won't make any money out of options. Here we are. For some of you, this is not new. We have some very, very good option traders in the room, and they will no doubt pick me up on my errors of wisdom. And I've really tried to simplify the explanation I'm going to give you. I've dumbed it down to a level that I could understand if it was presented to me back when I started this, because it's a sort of topic that you can get lost in the weeds if you're not careful. So I haven't presented this before. I've written this stuff over the last year, and I've gone back and kind of pulled it apart and put it back together. So I'm hoping that it comes across as a simplified explanation and some reference material you can use when you go home to make some sense out of all of this stuff. And I've tried to present it in an order that makes sense and removes any confusion. So I'm really trying to give you 20 years in 2 hours. It's kind of a tough ask. I'll go as slowly as need be. If you've got questions, please ask, but maybe be conscious that we're trying to keep this simple. If you have some exposure to options, I'm not going to be talking in detail about gamma or delta or theta or implied volatility. I'm going to talk more holistically about how to use these things without having to look at those calculations too closely. There's a whole bunch of great strategies you can put together using what's known as the Greeks, the change in price, the change in volatility, but we're not going to go there today. We're looking directly and specifically at directional trading using these products. Did Gann have a view on options, or did he use them? Yes, he wrote a book. He wrote a book called How to Make Profits Trading in Puts and Calls. Has anyone seen the book? Believe it or not, I walked out without the book. It's sitting on my desk at home. We were talking yesterday about numbers and things being related. Why would you think he would actually call this thing How to Make Profits Trading in Puts and Calls, not just How to Make Profits Trading Puts and Calls? It all relates to 19. He's pointing you back to 19. He published the thing on Wednesday, the 26th of May, 1937. Oh, there's the book. So John brought it. I'll grab it and just, if you haven't seen it. One thing about Gann, if he gives you, it's a small book, it's only a few pages, it's not huge. And so that's what it looks like. I'll get it back to John in a second. If Gann's written Wednesday, 26 May 1937, pay attention. If he writes 1937, doesn't really matter. If he writes May 1937, matters a bit more. The more detail in the date, the more important it is if you're going to do any deeper research into Gann. There's a reason for it all. He updated it in 1941 and included a section on selling puts and calls. Some of you would know that as stripping premium. It has open-ended risk if you don't have a stop strategy. We do have a couple of proficient strippers in the room. No names mentioned. A stripper? So now you know who the stripper is. You can bail her up at lunchtime. Look, it's a great strategy. We're going to talk a bit about this moving forward. When you buy a put or a call, you are limited in risk to what you pay for the thing. So if the market was going to go up, you'd buy a call. If you think it's going down, you'll buy a put. If you pay $200 for the thing, that's it. That's the limit of your risk. If you happen to sell a put or sell a call, you get the money, that the premium comes to you. But if the market trades against you, you are exposed open-endedly until expiry. And we're going to talk about it, but it's a really important thing to come to grips with. Craig's going to be here tomorrow. I'm not sure. You have to have your account set up in a specific way to be able to sell puts or calls. You can't just necessarily do that. You need a certain amount of margin in your accounts. So what's an option? An option's just another trading vehicle, is the way I think of it, like a CFD or stocks, futures, bonds, or options. It's another vehicle, something else we can use. They're the weapons of war. I think of them as weapons of war to conquer the country of profit. Sometimes you get beaten up. In a nutshell, an option is simply this. It's an agreement that gives you a right, but not an obligation, to buy or sell something at an agreed price at an agreed time in the future. Gives you the right, but not the obligation, to buy or sell something at an agreed price at an agreed time in the future. It's not a commitment. Options have their own specific uses. They also have their own idiosyncrasies, pluses and minuses. They're not a get-rich product, although they can offer huge opportunities. And I'm going to show you tomorrow, we're going to look at a trade that I took last year. And I'm going to show you how I use those in relation to form reading and the forecast and general geopolitical stuff that's going on to make a little more money out of the market. These are the sort of products that when you get them right, they can give you the 1,000 to 1, 2,000 to 1, 3,000 to 1 return that people talk about in the general text. And you have a better idea how that return's going to look because you have an idea where the top or the bottom is going to be, and you have an idea where the next leg should go, because we have a forecast, or because we're going to make a double top, or we're looking at a double bottom, and we can expect the thing to bounce by 50%, for example. Some work out, some don't. Mark in the room here and I have been trading bean options this last year. We had a couple of really good trades, and then we had one last year out of the top. The market just didn't move fast enough, and basically it was a wash. I didn't make anything out of it. I made something, but I didn't lose money, but I didn't make a lot of money. And if you don't get the timing right, and that can be difficult, then these things can expire worthless. They may not be for you. Not everyone likes grapefruit, and these things can leave a sour taste in your mouth if you're not careful. My first foray into options, I thought I was going to make $1 million and loaded up this position and just did exactly the opposite. Was not very profitable at all. So the main purpose is to hedge or protect another position. That's why these things were developed. An example, a crop of physical grain or a portfolio of shares. You can pre-sell grain at the elevator in the US particularly. I know how that kind of program works. They can also be traded as a standalone plan. So you might have a plan to trade options around specific criteria. They can be used to have short exposure whilst not selling your long positions, or vice versa. So say you're long Commonwealth Bank and you believe the market is still going to go up, but you think we've got a short-term retracement potentially, you might want to buy some puts, in which case you could take some money out of the short side whilst you're still holding your long position. So you're not copying the double brokerage, if you like, by the time you get out, go short, get in again. They can be used commercially in, say, a real estate transaction. You know, you might purchase an option or a right to buy a house at a predetermined price in the future. Has anyone ever done that? Yeah. Happens a bit with agricultural land and farms. Yeah. I had a mate in Sydney, and they used to do a bit of this with small businesses. You know, they'd take an option on the business with a right to manage it, and they would go in and basically turn the business around under the period of the option, and then they would complete the transaction and immediately flip the business again. It was a very profitable little gig. So they didn't ever buy the business. They just had an option on it with certain criteria attached to it. I've said this again, most options expire worthless, and we'll get to why in a minute. So there's strategies. So you would have all heard of option strategies, you know, backwards credit spreads and spotted flying butterfly things, calendar spreads, ratio spreads, butterflies, iron butterflies, the jelly roll, that is a real one, condors or iron condors. Anyone ever traded a jelly roll? No? Don't know what you're missing out on. Straddles, the Christmas tree call or put, spotted cockroach cluster bombs, my favourite, but it's not so real. I just look at those things and I glaze over. You know, you're trading two different products together, and really what you're doing is taking a little bit of profit out of the middle, as opposed to trading a directional position where you have the maximum upside in the trade available to you. Does anyone trade any of these things? No? Yeah? A couple of guys here? Perfect. There's heaps of them. That's just the tip of the iceberg. And the good thing is my brain hurts and we're not going to talk about any of them. So if you think that's confusing, wait till you start placing the orders. You know, what strike you in, what contract you in, how's it all work? We're not going to go into any of that today. And the reason I've put it here is because the questions will come up, why aren't we talking about ratio backspreads or butterflies or something else? We're not going to do that. Gann didn't do that, certainly in his early description of trading puts and calls. Yeah, the jelly roll and the cockroach cluster bomb is just plain nasty. Strategies are mainly designed to protect your capital, but often have limited upside. That's worth remembering. We want to protect our capital, but we don't want to limit the upside. We want to kind of make as much as we possibly can out of these things. Strategies are generally complex. They generally limit your risk and they limit your upside. So I guess if you're really risk averse, trading one of those funny strategies could be good. You can probably trade a little closer to the money, I would suspect, but you are. I just think that when we have a mechanical system that we can trade a futures contract or a CFD or something on, we can do something a little different that gives us better exposure to the market with limited risk, and that's what we're going to talk about. So my approach is directional. It limits risk, but it has an open-ended upside. I haven't read many books, if any. In fact, I think I've read one that use options the way I do and the way Gann kind of suggested to use options. And I'm going to give you some ideas on how to trade them as a directional tool, which potentially can allow you to take large sums of money from the market if the conditions are right. Now, one of the things that happens is when you get into these trades and you start making a bunch of money, the greed monster starts to kick in. You have to be prepared to take some off the table. You have to know when you think enough is enough, because it's very easy to watch an option position go from zero to hero and back to zero again in a very, very short period of time. I'm talking about days, not months. So you might want to think that if you've got into a position that maybe you've got 20,000 bucks exposed and the thing's up 200,000, you might want to take some off the table because it could be worth 50,000 2 days later. I don't use them in lieu of Gann's and my basic mechanical method. I want to make that very, very clear. If I'm not trading the mechanical system, then I'm not trading options in that particular market. And I will tell you how I do that, but essentially what I do is I use these things to supercharge my trading plan. So if I'm trading a directional move, say to the upside, I will trade that with the futures, and I will use a percentage of the profits I make from the futures trading on the mechanical system to apply to an option position for the run to the short side. Does that make sense? I'm using the market's money all the time. I'm not using my money. I'm not risking anything out of my own pocket. And if you haven't been here before, you'll know my views. If you have been here before, at least you'll know my views on money. It's the market's money until it's out of your trading account and in something else. A bank account, art, gold, silver, I don't know, something else, some other product, real estate. They become particularly useful if you've got a forecast like the bean forecast we've got on the wall over there, or an obvious setup based on form reading, where you may want a lower risk speculative play, like the wheat double top last year. If you want to have a look at a chart tonight, you could have a look at natural gas. It's had a lovely run. It's come back now and it's making a little triple bottom at about an 87% retracement. Shitty number, I know. Gas could be one that's worth taking a look at. Also, the 10, 20 and 30 year cycles look like they're bottoming here on gas. So there's a bit of free chicken there. Is that me? Maybe. So how do I use them? Basically, I'm primarily interested in buying puts or calls. I simply buy a put or a call as a directional play based on technical analysis, either a forecast, a double top, a double bottom, etc. If my analysis shows upside, I would buy calls. If my analysis shows downside, I would buy puts. Is that fairly straightforward? Stop me if you don't understand. I've not done this before, so I've tried to dumb it down to a level that would make sense to me, but it may or may not. Your risk is limited to what you pay.
Do you use a separate chart or the same chart?
Terry's asked if I use a separate chart or the same chart. I use the same chart. I use the same chart. I use the futures chart. Well, in my case, a futures chart, because that's predominantly what I trade. But if you're trading shares, you would just use the standard share chart. Because you're trying to, a lot of this is around form reading. It's around observing what's happening in the market and what's going to happen, what you believe is going to happen in the market based on your analysis, and then placing a trade to take advantage of what's going to happen in the future. We're actually trading in the white space on the right-hand side of the page. It's not quite, you have to be thinking ahead, a good way ahead often. Often I can be thinking ahead by 3 or 4 or 6 months, maybe more. So you've got to be thinking about what the market's going to do and then making decisions around the moving parts inside this particular product, which we will get to. I don't want to kind of preempt that stuff. The advanced strategy would be hanging around with Ellen and doing a bit of stripping, selling puts or calls. So you can sell a put or a call, you can collect the premium. It's basically free money for old rope. If my analysis showed upside, if I was looking for the market to go to the upside, I could sell a put at the low and take the premium. And when the put expires, you keep the premium. But if the market traded below the strike, say the low was, say you sold a put for 4,200. If the market traded at 4,100, you're exposed for the premium and the difference. If the market trades at 3,800, it's not so good. If the market trades at 3,000, you're probably ready to go to the gap. So unlike if you bought a put, if you bought a put at the top, you're only exposed for whatever you paid for it, 200, 500,000, 1,200, whatever it is you paid for it. That's it. That's the limit of your exposure. So when you're stripping premium, when you're selling puts or calls, you are exposed. And there's a way to protect that exposure. But again, it's another moving part. And I try to keep things as simple as possible because I'm not that clever and I screw things up really quickly. So you want to keep it as simple as possible. My analysis showed a downside. I could sell calls, the same thing. Nothing's really free. Unlike simply buying options where the risk is limited to what you pay for them, being a seller has open-ended risk. I want to make that very, very clear. It's always, when I first looked at this, I'm going, oh, how good's this? You just go and sell puts and calls and put all that money in your pocket. It's fantastic. Until one goes against you. I do have a strategy that I will share with you to protect you in that situation. We're going to focus on the basic strategy, which is buying puts and calls, and we'll see where that goes. Any questions so far? Is that kind of simple enough? Resonate with people? Okay. I might get through this before lunchtime. So what do Gann and I have in common? The contents of Gann's book, if you don't have it, I would suggest you get hold of it. You can get it from Lambert Gann. You can probably get it online too. It's more a text. It's not so critical where the page numbers fall. But I think
you might find it's sometimes published as part of the commodity and stock courses.
Oh, actually,
if you got Brad Cowan's edition, he has a volume called Rare Writings of W.D. Gann,
yep.
And it's in there, both books.
Anyone got Brad Cowan's work? No? Yeah, so that's a good one, Tim. I think it might have been in the back of one of the editions of the commodities course as well. You might find it. It's only it's not big. It's only like, I don't know, 10 pages or something. It's worth having the book and having a little look. But like everything Gann writes, it's not as easy to read as you would kind of think it should be. So I only had the two strategies that Gann described in his first book. That's buying puts or buying calls. It wasn't until 1941 that he started talking about actually taking premium. So you can see how he'd progressed in his thinking as the markets progressed too, no doubt. I don't know what was going on back then, Tim, do you, in terms of the availability of options?
Option trading was much less sophisticated back then. I don't think you could actually trade options on commodities until about 1980. So right. Gann was never able to trade them on, say, beans, which is why when you see him use the word option, he actually means futures contract. Yep. It doesn't mean an option. Yep. And as to stocks, I don't know what was available, but I suspect it was that all the strategies that we use today, or people use today, didn't exist probably back then, and it probably was simply buying and selling puts and calls. Yeah,
I think you could trade them on stocks because he does refer to that directly in his writing. Okay, so the secret benefit to options for me is that I can be wrong initially and still make money. So whereas if we buy a futures contract, we put a stop in the market beneath the swing, for example, we can be stopped out and we've got to get reset. If we bought an option on that same trade, so we bought a call instead of a futures contract, the market could trade below the position where we bought the call. The market could trade below the swing. The market could do a leg down and we could be short the futures and still long the call. You don't have to worry about the thing because you've got time on your side. These things don't expire until a time in the future. So that thing could go from, say you bought it for $500, it could go to a point where it's worth $20 and then at the end could be worth $5,000. So you don't have to worry about them so much. You can be wrong initially and still make money out of the thing. So how many times have you been in a trade or you've taken a trade where you thought this is a great setup, the market kind of goes in your direction, comes back and stops you out, dribbles around for a couple of days, goes again, comes back and stops you out, dribbles around for again, goes again, and then it goes. It takes 2 or 3 goes to get set. If you're in a call position in that situation, if you'd bought calls, the market can bobble around like that all it likes, and when it takes off, you're still in the position, you didn't have to get reset, didn't pay any more commission, you are still in a position to take advantage of that move to the upside. So what I've said here is the underlying could trade above or below your stop you out of the futures trade, which means you've got to crystallise a loss and then reset your position. If you're not stopped out of your option, you still own it. Obviously, if you're trading a futures contract, you do not want to be trading without a stop, because the market could hypothetically stop you out and keep going down, whereas an option, you've already got the fixed risk. One thing I would say is I'm interested in trading options if the premium is less than the risk on the futures contract. That's a big thing for me. Just throw that one in there. If the futures trade has a risk of $1,200, I'm not really interested in buying an option where the premium's going to be $3,000. But that's just me. That doesn't mean that it doesn't work, it's just me. So if the market has one last gasp before it keeps going, then you're still in the trade. Effectively, you can be wrong and still have a position that makes money in the longer term. Sound attractive? Yeah, it can be. So if you're trying to make a long-term play based on your forecast, it can be hard to hold a position in the futures. So, you know, if we think that the index is going to make a top in 2026, you can't really buy a futures contract that's going to be good through till 2026. Probably can't buy an option either. But what I'm saying is that a futures contract expires every 3 months, but you could go out and buy an option 12 months into the future. Put it in the bottom drawer, don't worry about it, look at it, you know, at a time down the track. So options have that advantage if you're buying out of the money, out of time, a long time in the future, that advantage that you don't have to be swapping in and out of positions all the time. Yeah, you don't want to be fooling with your short-term mechanical strategy. I think that's what I meant to say there. So the mechanical strategy allows me to keep banging away with the mechanical system using the swings or the rule ones. The options are based on a longer-term view of what the market's going to do. So I can be long a whole boatload of calls, for example, thinking the market's going up, and I'll still be taking short trades in the futures. Does that make sense? It's kind of like you've got to rub your tummy and rub your head at the same time. It's kind of a little bit of a mind meld. So let's take a look at an example. If your market was trading at $12 in October, this is actually a real market. If the market was trading at 12 in October and your analysis suggested it will rise to 16 by March, so we're assuming the market's going to go up in the space of 6 months. The chance of holding a futures contract that long, 5 months away, is very low. You're going to have a rollover somewhere. You're going to have to roll out of the position, roll into a new position. The chance of being in the futures trade in the same direction for that long is about 0. The market's going to have a reaction. You're going to put in 5 waves and 3 waves and 5 waves. You might get to the $16, but it's not going to be a linear progression. Ties up capital, and it stops you trading the swings as they present. So if you were to buy a futures contract and try and hold it for the 5 months, you've got to sit through all of those drawdowns, all of those pullbacks against your position. You've got your capital tied up, generally large amounts of capital in terms of margin. If you're trading the SPY, good luck. And it would prevent you from taking the counter trend trades if you were trying to hold it for the long haul. Is Gann's demonstrated in something, you know, move your stop up behind the weekly swings or something, but you miss all the counter trend moves. So using an option, I can take all the counter trend moves trading the futures or CFDs or something else, and I can still have a long-term view and a long-term position using an option. So this was the, where were we? If you believe this is the low, around October, 13th of October, in this particular market, you would be long the futures right here. Would you not, on the swing? Can you see that? So there's the swing. You'd be long here on rule 1. And then the market proceeded to do this and stopped you out. Can you see that? would have been stopped out here, if not before. And you should have gone short here on rule 1. So now you're in a position where you believe the market's going to 16, but it's not going there yet. Your low's been breached, the trend is now well and truly down basis the mechanical method. Now, the market did this. This is what it actually did in the long term. You got long the futures here, you were stopped out in here, and then the market finally got traction, started to move. Now, if you bought a May call in this region, the option's still alive here. It doesn't matter what happened in this period of time. Does that make sense?
John, is the premium more expensive the further out you buy the option?
It depends on the price. We'll get to that in a sec, but options are priced based on option value is determined by time and by the underlying value of the product. There's 2 parts to the pricing model. So what happens is the further away from price you go, the cheaper they become, but the closer to expiry you become, the more expensive they become. Yeah. And that's where the art of these things kind of comes in. And you can use stuff like the Greeks, which we'll talk about briefly shortly, but rates of change of option value, basis, underlying time remaining, or the current price. You can do all sorts of funny things to get closer, but we're not going to do any of that. We're just going to say, if we think the thing's going, to $16, and we can buy an option here for $200 and we can sell it here for, $1,200, we're probably in pretty good shape. That's what we're going to look for. So the option's still alive there, and you can still bang away with the mechanical system. And this is the important thing, because if you stop banging away with the mechanical system, you lose all the value in all that work we've done for the last 7 years. You've got to keep going. You must keep going. This is not a panacea to make a bunch of money faster than the mechanical system will. Lots of blank faces. Can you see what I'm doing? Does it make any sense? It's another layer to the trading plan. Yeah? A plan within a plan, if you like. I'm not changing the existing mechanical plan. And I don't disregard it or stop using it. Heed this well. I put that in there because I really can't. I guess the fear I have is that I start to put this stuff out there and I start to show you some trades and you start to see some of the results, which in some cases are incredible, but it's not necessarily the norm. And I might get one good option trade every 12 to 18 months around the forecasts that I'm trading them around. Now, if you're stripping premium, you can do that basically every day. There's daily expiries on the E-mini. You can take premium out of those things every day if you want. But it's a whole different ball of wax. So what if I told you that March option, that 1450 call, cost me $180 way back in October? So it's the chart we were talking about back here, this chart. So back here I paid $180 when the market was trading at 1200 or thereabouts. And I bought a 1480 call and I paid, what did I say, $180 for it or something. It's cheap. Why is it cheap? Because nobody thinks it's going to get there by March 2020. They're not expecting it to go there. When markets are running down or grinding sideways or breaking back against a change in trend, the options, the longer term options become cheap, relatively speaking. Out of the money, they're not going to make that price. You've still got plenty of time, the thing's not going to expire, and they just become cheap. No one wants them. Well, sometimes I want them. You can fight Ken Gerber and I for them. When we got there in February 2020, that thing was worth $3,500, and the market was trading at $1,500. So $180 cost, $3,500 return. Anyone like those numbers? Not really, no? That's 19 times your risk. That's pretty convenient, isn't it? 1900%. I didn't actually. I wrote all this stuff separately. 19 times your risk, or 1900% on your money. Not bad for government work. It doesn't work out this beautifully all the time. Terry?
Can you get out of the trade of the option
Sure.
before the expiry date? You see there's a profit there, maybe at 2,000 or 3,500, say, yeah, I'll take that.
Yeah, so Terry said, can you get out of the thing early? Of course you can. And I trade them a bit like futures once they're running. You know, if the market starts running and I've paid $180 for the thing and it's now worth $1,000, I'm going to move a stop up to like 180, 200 bucks or something. I'm not going to let a profitable trade turn into a loss, ever, if I can possibly avoid it. But yes, no, you can trade and you can buy them and sell them. You can do whatever you want to do with them. And you can still be banging away with your futures contracts. 19 times. Let's do that then. Yeah, it's a hard no. And the reason is they don't all work out like this. If it takes too long for the market to move to the higher level, then time will start to erode the value of the option. So you could have an option you paid $180 for that is worth, I don't know, 1,500 or 1,000 or 100. Could be worth nothing if you're right close to expiry at that price level. And that's what happened to Mark and I in the beans last year. Those puts, the market finally got there, but it took too long for it to run to the price. You can have a forecast, be in right, and still not make anything from an option position. There's a lot of moving parts. They're an addition to my plan, they're not the plan itself. That's me harping on about keep trading the mechanical system. So here's another play in October 21. By selling puts, you could have the market pay you to buy the calls. I don't want to get ahead of ourselves. But what you could do at the bottom is you could have sold a put, taken the premium and used that premium to buy the call. So it didn't actually cost you anything, so long as you protected the put that you'd sold. They don't always work out. They don't always work out that well. And as Terry asked, can you get out of them? Yes, you can. Manage the trade, the old chestnut. You know, manage your stops. Put a stop on an option position. Be prepared to sell it at a certain price. The one thing I'll say about options is you need to be patient, really patient. You can't look at these. If you're doing what we're talking about doing, looking at longer term stuff, there's no point looking at the thing every day and worried about a $50 fluctuation in the price. You have to be patient. They go in the bottom drawer and you look at them as price starts to move towards your target. Otherwise, you'll be driving yourself up the wall. Nuts. You'll know very quickly if you're suited to this style of trading or this product. Because if you can't leave it alone, just don't play with it like this. Or modify the plan to trade something a lot closer. I mean, you could use these things to trade swings if you want. You've got a target, you've got a swing set up, a target, a milestone target. You could look to buy an option at that milestone.
On a daily chart?
On a daily chart, yep, absolutely. Trade them intraday if you want. They move very quickly. Option pricing moves very quickly intraday. So there's another scalpel help cut you to bits. Trading options on a 4-minute chart. Should be good. And I've said here, you can use them, you use what I'm showing you for shorter time frames. Remember the contents of Gann's book. We're only going to use the two primary strategies. That's to buy and sell, to buy puts or calls. None of the fancy kind of strategies.
Just a point, John. I just checked on Amazon and you can pick up Gann's book for $2.91.
$2.91 if you want to buy Gann's book on Amazon. There you are. So just Google or Amazon it, whatever it is you do, and you can probably pick it up there. Is it a PDF or something? Or?
It's just a download.
Yeah, yeah. So I'd suggest if you're interested in this stuff, it's worth having a good look at it. Okay, Any questions to date? I'm not sure that I made that as cohesive as it should be. Yeah, pretty simple.
With your, with the selling of them,
Yeah.
so if the price gets there before the time, then you still sell it. Like say it got there in December, for instance. Or do you
Yeah.
have to wait until-
Oh, no. So the question is, can you sell before expiry?
Yeah.
Yeah, absolutely.
Yeah.
Yeah, absolutely.
Even if it's got the price.
Well, once it gets to the price, you're probably interested in being out anyway. Yeah, I'll talk about that in the next session. But once an option gets to the strike price, it moves at the same rate that the futures contract would or the stock would.
Okay.
So if you're trading beans, it's $50 a point. Every point above the strike will be worth $50.
Right.
So there's a point where they're almost not worth keeping. You may as well get out of them and hold the futures position, so long as you can keep the stop. The only reason you would keep it is because those fluctuations would keep you still in that trade if you're expecting a higher price.
Yeah.
And the way I trade them is that we'll talk about it in detail, but I'm looking at where I think the market's going, and I'm taking a very conservative position because you want to be what they call in the money. You want to be at your strike before expiry. Generally 30 days before expiry, when time starts to decay your value very, very quickly. We'll get into all of that. Yeah, Gus.
You mentioned stop losses on options. Is that something you put in when you place the order, or do you have to...
No, I generally buy the option, so I'll buy the option, and then when it starts to move, I'll just go back and refresh, and then I'll put some sell order in if I want to get rid of it. Yeah,
So it's a separate order, not a...
it's a separate order. Yeah, depends on the platform. You can probably put a stop in. I know you can on CQG. If you want to put a stop. But I mean, if you're paying, generally when I'm trading like this, I'm trying to buy these things for like less than $200 a piece. So I'm not too worried. I kind of let the thing run and then I'll get a stop in. Otherwise, you end up getting yourself stopped out. You're in the same situation as the futures, which is not where you want to be. Okay. In the weeds. I'm going to get through this a lot quicker than I thought I was. Okay, so we saw some blue sky there, 1900% on that particular trade. It's pretty good. But if you think you bought 10 of those things, you bought 10 of those options for $180 a piece, that's $1,800. That's less than one futures contract risk generally. And then the thing's worth $3,500. So you just made $35,000 out of that trade. It's not bad. And we have other supporting documentation to support what the market's likely to do with our forecast. Now let's look at some more terms in detail. I want to try and break it up. I've tried to put this together in a simple form. I'm just always a bit sceptical I get it right. Let's look at some terminology, what you hear and what you need. Let's get into it. When I say what you hear and what you need, you'll read all these complex books on option strategies, and I think for me it was more confusing than it was useful at the end of the day. And it wasn't until I really found and got into Gann's book that made any sense of it all. So puts, two types of options. Puts. I just want to see if the heating's still on. Is that air conditioning on up there? It's warm in here. Ridiculous. Yeah, no, we're not going to run that. It's ridiculous. It'll be 40 degrees in here in 2 minutes. There's a reason I don't like these rooms to be 30 degrees. It's because you go to sleep. That's why I don't like really warm rooms to kind of work in. You doze off. And quite frankly, sitting up here, it's quite uncomfortable. There's only two types of option. There's a put or there's a call. If you buy a put, you believe the market is going down. If you buy a call, you believe the market is going up. Have we got that? Is that fairly clear? Everyone get that? Because it's really important. Remember, we don't think. We don't think the market's going up. We don't think the market's going down. We have a technical reason and a plan that tells us that's what should happen. And we've generally seen it happen before based on that plan. And when I say that, if you have a look at the bean charts over here, that forecast, there's 90 years of bean data on that wall, and that forecast has been out by no more than 31 days in 90 years. That's pretty good. If you're trading options way in the future, that's very good. Did anyone do any work on that thing after the Bangkok event? I know Mark did. Yeah, a couple of you. So some other terminology: premium, strike, American or European style options, in the money, out of the money. All these things kind of add to confusion. There's a lot of other terms, but I don't want them to confuse you. It's a bit like my KTR strategy. I want to keep it simple. You can use angles, math, physics, square and iron, but you don't need it if you're using the KTR simple mechanical system. Some other terms that you may encounter, I don't want to dwell on them. Implied volatility, snapshot of the market. Implied volatility is a snapshot of the market's view of likely changes in underlying security price. So whatever the underlying price is changes, the implied volatility will go up and down in relation to that. Requires a deeper understanding of option pricing theory, which we won't go into today. It's probably a day to actually talk about option pricing strategy and how it's all put together. It's quite a complex thing. The key to know is what happens in your market when the implied volatility goes up or down. If you're in a bear market, does the implied volatility increase? If you're in a bull market, does it decrease or increase? In things like beans and wheat, implied volatility will increase in a bull market. So as a market advances, implied volatility will increase much faster than it will in a bear market. Indexes are the opposite. The S&P, the implied volatility increases faster in a bear market than it does in a bull market. Really important to know if you're trading those things. Terminology around the Greeks. These basically measure sensitivity of an option price to its underlying product. Delta, gamma, vega, theta. Anyone heard of these things? Yeah. You can develop an option trading strategy around something like delta, the underlying change in price. You know, you could buy a delta of, say, 30 and sell a delta of 70, and you just keep rolling down. You don't care about the strike so long as the market's moving in your direction. You just keep buying 30 and selling 70, and you keep going till the market turns. Our old slumlord mate that's not here, he's pretty good at that stuff. Monty. Hi, Monty. So delta, the rate at which an option price changes in relation to the underlying asset. So is the option price increasing faster or slower than the underlying futures value in the case of something like beans? The price sensitivity relative to an underlying product or asset is between 0 and 1 for a call or 0 and -1 for a put. A long call with a delta of 0.3 would have the result of increasing the underlying option price by 30 cents. And it can also be used as a bit of a guide as to whether the option will expire in the money or out of the money. A delta of 0.3 would be about a 30% chance of expiring in the money, which is pretty low. But you've got to remember that we are looking at something longer term, so a delta of 0.3 today may be exactly what we want, because that means it's going to be a cheaper option. There's only a 30% chance of it expiring in the money. I don't want to dwell on these, I'm just kind of giving you a bit of an overview. Gamma relates to the rate of change of delta versus the underlying asset price. See how the complexity starts to come in? So we first have to understand delta, and then we have to relate that to an underlying asset price, and that will give us a valuation for gamma. Vega is a rate of change of an option value against implied volatility. We all glazing over? I am just kind of going through this stuff. A vega of 0.2 indicates you could expect an option value to change by 20 cents if the implied volatility changed by 1%. So again, we have to understand what each of the Greeks does in order to figure out what the other Greek is likely to be of any use to us.
I'm married to a Greek.
How's that work?
It's obviously confused.
How's his implied volatility? So Kathy said she's married to a Greek and his implied volatility is not very good. Or very good, depending on where you sit. Theta measures time decay. I said that options are priced based on time. They have a time component and they have a value component. So theta measures the decay of time. The closer to expiry you become, the closer to expiry you get, the faster time will eat into your premium. It will erode the premium really quickly. And that's where you can become a little complacent. You've got this option that's got all this profit sitting in it and you're not watching time, and before you know it, in the space of 2 or 3 days, that option that's worth $1,000 can be worth $350, and you've left all that profit on the table. That's why I say you've got to be very conscious that greed doesn't take the better of you, because the numbers can get pretty big. Ken Gerber and I have been trading options on beans for a long, long while, and we've had some pretty good trades. And one of the big questions that always comes up is where do you cash some of your chips in? What's reasonable? I get some weird looks, but what's reasonable? You know, like if you're banging away with your $100,000 account and you're making a few hundred grand a year, and then all of a sudden you're in an option trade that's got $1 million on the table, is greed going to make you hang on? Well, it actually does. You've really got to fight the impulse that it's like Bitcoin. Here's Bitcoin, my favourite market. I know so many people that bought Bitcoin at like 55 and it's trading at 70 and they refuse to sell because they believe it's going to go to 100. I know people that bought Bitcoin at 25 and it's trading at 70 and they refuse to sell because they think it's going to 100. They wouldn't take any off the table. The same thing will happen to you with options, because the numbers get so big and you start eyeing off the new Bentley and you're going, well, you know, I could get the fancy seats if I can just get a little bit more out of it. But I just implore you, it's a discussion about trade management, which we're going to talk a bit about later in the week, but you have to be very conscious that large sums of money, when they appear, you should pick the fruit before the cockatoos get it. Does that make sense? Right.
Just to be clear, it looks like the key thing to be tracking it, once you've got your forecast in place, we're going to have a low here, expecting a high here, the key thing to be tracking would be the Vega, because that's your implied volatility.
Yeah, but you'll see I'm not really interested in any of that. I'm interested in the actual physical cost of the option, and I'm interested in being able to be in the money at my strike price 30 days before it will expire.
I'm thinking in terms of when you take your initial position, you want the Vega to be down as low as possible.
Oh yeah, I don't even look at it. I just know that I want to buy stuff. I'm really looking to get to where I think, say, the high is going to be, and I want to be basically saying, well, if I think the high is going to be on the 20th of March, I need to have something that is expiring in April or May, because I need to make sure that I'm well and truly in the money before expiry and time starts to eat away at the premium value. If I was going to trade one of these things, it's probably Delta. I like trading Delta. And it's really cool because if the market's trending, you don't even have to worry about the price or the expiry. You just take the next one at 30 and sell it when it gets to 70. So time decay in value speeds up as you approach expiry because there's less time to achieve your strike and earn profit. People are less interested in them. Sorry, I've just had a mental blank. Complete mental blank. Time decay speeds up as you approach the expiry date. That's all you need to know. And you need to know that it accelerates very, very quickly after 30 days or 30 days before expiry. Theta's good for sellers taking premium. So if if you're a good old-fashioned stripper, and you like to take a little bit of dough out of the market, you really don't want 30 days to expiry. You want to get the biggest premium you can with 2 days to expiry, because if it expires, you keep the premium. Does that make sense? So as a buyer, we want as much time as possible. As a seller, we want as little time as possible. You could go in and sell, close to the money or close to the swing puts or calls 2 days before expiry, and you probably make yourself $1,000 a day, so long as the market doesn't come back and bite you. And it's a good, strong, trending market, and I'll show you how to do some of that stuff. What sort of time frame are you looking at, Ellen? Do you?
40 to 50 days out.
Yep.
At about two to 300 points away from the current price.
Yep.
But I mixed with some option traders who actually buy in the money.
Yep.
Sorry, sell in the money.
Yeah, right.
For about 60 days out.
Yeah, right.
Insane stuff.
That's another discussion, and it's I think there are so many different strategies, really, I think, in relation to how you trade options, and you've got to find one that works for you. I'm only looking at the one that works for me and the one that Gann talked about, which was basically trading against a forecast or a longer term view. And a longer term view, like if you're a 4-minute trader, a long-term view is a daily chart. I mean, that's like forever when you put it all in perspective. So theta's bad for buyers of options. An option that's not in the money will decline in value at an increasing rate as it approaches expiry. That's why I say you need to be in the money. You need to be in the money before the time decay starts eroding the premium. So it's this real sweet spot that you're trying to get to. And it's not hard to find if you're a bit conservative. And that's why I said the general sweet spot's 30 days before expiry. You need to be in the money, you need to be at your strike price 30 days before expiry, or 45. Or, the longer you can, the better. But often you won't get an option that's cheap enough much further out than that. Are we brain dead yet? I kind of am trying to present this stuff. Don't dwell on the Greeks, please. I just had to mention them because you're going to come across them. They do have some, they are obviously important. The closer to the money and the closer to time that you trade these things, the more important the Greeks become, in my view. But I'm looking for speculative trades that are further away, cheaper options, lots of time. Conservative strikes. So you can go do some homework on these things yourself if you wish. If we ever do more of these events, maybe we can pull some of these things apart. There's a lot of option professionals out there. There's a lot of good books in the marketplace. I don't have anyone I really think I would necessarily recommend above anyone else. The CME website has some good material on it. I think even the ASX has got some good option material. Yeah, be worth taking a look at if you want to kind of learn some more about that sort of stuff and have a think about how to put it together. And as I said, you can develop some pretty funky trading plans using the Greeks, like my little kind of suggestion around delta. But I really want to keep it pretty simple. So in a nutshell, an option is simply this. It's an agreement that gives you a right but doesn't oblige you to buy or sell something at an agreed price at a time in the future. It's not a commitment. A call gives you the right and you're not obliged to purchase an underlying futures contract or share at a specific price at a time before expiry. You'd buy a call if your analysis shows the market's going up. A put gives you the right, I've gone through the same thing here. I've put them in here so you can read them when you've got the notes yourself and they'll make sense. You buy a put if the analysis shows the market should go down. The premium's the price you pay for the put or call. That's your maximum exposure. I actually think of the premium as what I'm paying for time, generally. I'm buying an opportunity. That's what I'm paying for in my simplistic mind. I can sell at any time and recover some or all of my premium and or profit, or take a small loss. If you figure you've got it wrong and you've got a whole bunch of these things and you paid $1,000 each for them, and you figure you got the whole thing wrong, you could sell them and recover some or all of your premium, depending on where you are in the cycle. The strike price is the price at which you're happy to exercise your put or call. So that's the price that you expect the market to get to. At the strike price, the market will move at the same rate as the underlying product. So if you're trading beans and they move at $50 a point, and you buy a $16 call, 16.01, 16.02 or better, the market is moving at $50 a point. Okay? There's two types of options, American and European. An American option can be exercised before expiry. So you can turn these things into a futures contract or into script if you want to. You notify your broker you want to exercise your right, and you can then own the futures contract or the stock. European options can only be exercised at expiry. So you can only convert them to the underlying asset at expiry. You can buy and sell them, but you can't convert them. You are going to be predominantly trading American type options, I think, depending on your broker and what market you're trading. Exercise simply means you can take possession of or are required to provide possession to the option holder. In the money, a call option is in the money once it's trading above the strike price. A put option is in the money when it trades below the strike price. Does that make sense? Yeah? Everybody get that? Yeah? An option is simply an agreement or the right, not an obligation to buy or sell something. I keep banging on about this at a time in the future. The fee for the agreement is a premium, and that's the extent of your risk. That's the maximum you can lose if you're a buyer of puts or calls. The strike is the purchase price and the price I agree to pay at a point in time. I want to give you a lifestyle example because maybe that will make it easier to get your head around. You know, I want to buy Bob's house. I was going to use Greg's house as this example, but he wasn't very keen on it. I can't complete the transaction until a time in the future, or I believe it will be worth more in the future. So maybe I need to sell a house before I can buy the new house. Maybe I think it's going to be worth more at the time more at the time I can complete, which means maybe I don't have to borrow the same amount of money. I don't want to miss the house. Apparently it's amazing, and you know, you've got to keep the wife happy. So I could pay Bob some money, a premium, for the right to buy the house at a price, which would be the strike, on or before a future date, which would be the expiry date, effectively locking in the time to complete the transaction at a fixed price. Now, there's reasons why Bob would be happy to do that. So the deal might look like this. I negotiate to give Bob $10,000 in premium or consideration for him to take the house off the market, and we agree that at a future date I'll give him $2.5 million for the house. Why do you think that might be attractive? Yeah. I've got a bit of a list of them coming up. But I mean, yeah, I'll keep going. If at the agreed date, expiry or before, I complete the transaction to give Greg his $2.5 million, I own the home. If the home's worth $3 million at that time, I just made a cool $500,000. We agreed, the price has been fixed, it's locked in. If it's only worth $2 million at the time, I could simply not exercise the option. So if I went back to the bank and the bank says, well, it was worth 2.5 last week, but this week it's really worth, $2 million, that's all we're going to value it at, I could walk away from the premium. Bob keeps the $10,000, and I just walk away from the deal. Alternately, I complete and accept that the $500,000 decrease in value on the day. Remember, the wife loves the house. That's the important thing. Exactly. Does that make sense? Does that example kind of make it a bit simpler to get your head around? If I didn't want to if I did not want to exercise the option, or I changed my mind, maybe it's gone down in value, or I can't complete by the expiry date, or the wife found a house she likes more, I could just walk away from the 10 grand. Now, $10,000, if you really want to do a transaction worth 3 million, is not a lot of money. It's a lot of money, but it's not a lot of money. I forfeit the 10 grand and Bob can sell the place to somebody else. The option expires worthless. Does that make sense? The option wasn't executed, the transaction never completed, the option expired worthless. This is why I've said it's the right to do something. I don't have to complete, not an obligation to do something. A real estate contract is an obligation. When you sign a real estate contract, you are obliged to complete, or you forfeit the deposit generally. So why would I do it? Well, the cost of the option in this case is way less than the 10% deposit required under a real estate contract. I put 10 grand down, I've got time to complete, I still have options. If I sign a real estate contract, I'm obliged to complete and the deposit's going to be $250,000 minimum. That make sense? So if you can get Bob to take the 10 grand and you know you're going to complete anyway, you're better off because you've still got $240,000 worth of free cash to trade your futures contracts with. Maybe I believe the value of the property will increase in the time frame between now and expiry and I can borrow more against it. Maybe I need time to sell an existing property or other assets without being exposed to the 10% non-refundable real estate contract deposit if I default on the purchase. Any gain in value at completion is to my benefit, but the loss as well if I complete under the option. Why would Bob do this? Anyone know why Bob might be interested in doing this?
Gets 10 grand.
Gets 10 grand. If you don't complete, he's got 10 grand. Maybe he doesn't want to deal with the open houses. Perhaps the cost of the option covers his advertising costs. So if you don't complete, he's got free advertising to sell it to somebody else. Maybe I've offered a premium for the house at expire and he's willing to wait for the extra money. So maybe he figured he'd get 2.1 and I've said I'll give him 2.5 if he waits for an extra 3 months or 6 months or something. So there's reasons why this works for the vendor as well as the seller. Can you think of any others? There's probably some others there. No?
Bob might think the price is going to go down.
Bob might think that's bang on, Tim. Bob might think the price is going to go down. So he goes, well, I think it's worth 2.1 and it's likely to go down because the real estate market's topped because I read Phil's book. And I'm going, well, I'll give you 2.5 to keep my missus happy. So Bob's pretty happy to have some skin in the game. So have I lost everybody? Haven't lost anybody. Lost myself.
John, what's the longest option time you've ever taken?
I think 8 or 9 months. Yeah, longest option time I've ever taken, maybe 8 or 9 months. Yeah. It really depends on the forecast and the timing. If you're looking at, say, something like beans, you might be looking for a 3-month run. You might be looking for, particularly if you're buying calls, it takes longer for markets to track higher generally, unless you're in the last part of the cycle. We're going to have a look at a market that was just a blow-off market, a bit like silver was in 2011 when Paul and I were trading that. And it's, but if you're looking to get into these things, I'm not buying right at the low. I'm buying as we go into the low. My position's already on before the market starts up because that's when they're cheapest. No one wants them. Market's plummeting and I'm going, oh no, it's going to 20,000. No, it's plummeting. No one wants them. They don't think it's going to go there. And this is one of the big things. I think, Tim, you did a workshop at one stage in the US with someone and you were saying that all these option traders, when they see what you can do with time, just go, hello, how long's this been going on? You go,
They were
well,
just blown away.
Yep.
They just said, if we had known this Gann stuff when we started, like these were professional option traders in some cases. They made a living trading options, But when we said to them, well, you can project where the prices and the time are going to go, and their jaws just dropped. And they said, oh, if only we'd found this 3 years ago.
You know, Gann's got some really good counts. Gann's got some really good counts, like 144. You'll see these things come out all the time. And if you're trying, if you see the market put in a low, you've got some counts for a low, say, rallies and comes back and retests the low, on the move down, you'll be able to buy some calls that are pretty good. And if you're looking at, say, a top and 144 count to the next top, potentially, that could be a really good position to buy some options. You know? And these guys that Tim's talking about, they didn't have any idea that these counts ever existed, this black art of being able to see repeating timeframes. They just didn't think it existed. And when you see that stuff and you start to think about how you might be able to monetize it, it becomes a pretty powerful thing. Now, I'm talking about really big picture stuff. I'm talking about these big forecasts. Like, we look like we're going to make a low in the beans maybe in September, around the 28th. And then we should rally into December. So we've got a 3-month window to make some money. Now, we can use some of our square root maths and the square root of 9 to calculate where the top will be. And then we can make some decisions on what sort of strikes we might want to buy. And we know where the time frame is, say December. So we want to be buying probably February options, which is still have 45 to 60 days to go in December when we get to the end of our, you know, our forecast. Now, the old option, the average option guys buying close to the money, they don't know that they can buy, they don't really have a time frame for when this thing should top out. So they're only getting this bit out of the market, and we can get this bit. It's really interesting stuff. So no questions? God, I've got some questions. How's an option priced? It's two parts. Simplistically, I look at it as intrinsic, which is price, and extrinsic, which is time. Again, they're just words. Intrinsic value only exists once the option is in the money. That's why I say that a premium to me is really just about purchasing time. Intrinsic value can be calculated as follows. If you want to know some math, for a call, the current stock price minus the strike price will give you the intrinsic value. For a put, the strike price minus the current stock price will give you the intrinsic value today. Time value is the premium in excess of the intrinsic value before it expires. All this sort of long-winded explanations. But the time value is moving all the time. As you approach expiry, the time value is decreasing. It remains fairly stagnant for a long while, but then as you start to get closer to expiry, it decreases very quickly. So you can have a market that's going up in value and the price component is gaining value, but the time component is losing value faster than the price component can gain it. So the value of the option does nothing or decreases. You may remember in past workshops I've said that risk is a function of volatility and price. You know, you come down in time frame because you think you're reducing your risk, but you're increasing the volatility, which increases the number of times you get stopped out of a trade. So whilst your risk, your physical cash risk is decreasing, you take more losses because of the volatility. And when you look at the whole calculation, trading the smaller time frame, in fact, increases the risk. It doesn't decrease it. Superficially, it decreases it. All you're doing is making it death by 1,000 paper cuts instead of death by one blow. You can decide which way you'd rather go. So I see what we pay in premium as basically buying time, which is what I said before. The further out in time we go, the more we pay, because the higher the chance we have of getting to our strike, we have more time to get there. I'm just trying to give you an idea of how these things get priced. The further out in time we go, the more expensive they become. The further away from the market the strike is, the cheaper they become, and then that combined gives you a price. So if you're looking to buy something that's way out of the money in terms of strike, the market's trading at $9 or 900, and you're going to buy something at $20, a strike at $20, 9 months away, that's going to be pretty cheap. If you're going to buy something at $10 with, 8 days to go, that's going to be very expensive. Does that make sense? Glad it does to you guys. It took me a long while to get my head around some of this stuff, I've got to tell you. I'm not the sharpest tool in the shed. This is really important. That's why I haven't put it in as an animated slide. You must know it before you start and remember it well. Time value generally expires fastest in the last 30 days of an option's life. So if you think you are going to make a top in September, say the S&P, you're going to make a top in September 21 or 22, that's going to be the top. You can't buy a September call because it will expire or be well and truly inside the 30-day window. You would have to be buying a December call, which will expire in December. That makes sense? So for me, the sweet spot, I'm harping on this 30 days. Ellen would probably have a view on this. 30 days far enough for you, Ellen, in that case, do you think?
Yeah, well, except I have a different view in that because I want them to expire early, I'm happy with the 30 days deadline.
Yep.
If I feel I'm too close to the strike price, those last 30 days give me the option to buy the option back.
Yeah. So Ellen's the one that's taking our money off us, effectively. So it's her shout at the bar at 3 o'clock.
So just like strippers.
Yeah, basically, just like strippers. Yeah. So when you're trading options, you're trading against Ellen. When you're trading futures, you're trading against me. So either way, we win. So what I'm trying to do is just give you a rough guide as to where you should be looking. You might decide you'd like a little more time. You might want to buy something that's 60 days away from expiry when you hit your target date. But you'll find a sweet spot that works for you. 30 is pretty good for me. Generally, it's never right on 30. Generally, it's closer to 45 or thereabouts. And sometimes with things like beans, where you have odd months, it doesn't kind of roll from quarter to quarter to quarter. You end up 60 days away or a little bit further away because you need to have that volume. The other thing with options is you don't want to buy something in a month that doesn't have good volume. It needs to have volume, and you don't want to buy some random strike that's got no open interest or volume. So, there's no point buying a 1045. You should be buying the 1050 or the 1060. You don't want to buy the ones that don't have anyone to take the other side of it if you want to get out of it. But that's kind of finessing it all. Kinds of puts and calls. So not all options are the same. Different kinds with different values. In the money, at the money, out of the money. In the money meaning if you bought a $9 call and it's trading at $9.10 or $9.20 or $9.30, it's in the money. At the money would be $9. You could buy a $9 call when the market's trading at $9. Or out of the money, you could buy a $20 call when the market's trading at $9. I'm going to give you a diagram. Most every course or book will tell you to play here, in or at the money. Pretty well everything you read will tell you to play here. It's the most expensive place to play, and it's also the place that has the least upside. I'm into the upside. I'm making my money, my cash out of trading the futures. These are speculative plays. We're playing for sheep stations here. We're not playing for, VWs. And I'm using the market's money, which we'll get to. Okay, and this is where I'm playing, out of the money, down here. An in-the-money option is an option that's profitable side of the strike price. The underlying product price is at or better than your strike. A 1200 call, if the product's trading at 1250 or more, the 1200 call is in the money. A 1200 put if the product's trading at 11.50 or less, the 1200 put is in the money. That make sense? You guys are quick. Like, this took me a long while to get my head around. So a 1200 strike, these next slides are going to be kind of not valuable probably. The underlying product trading above the strike price is in the money. An underlying product trading below the strike price, a put is in the money. So a call's in the money above the strike, a put's in the money below the strike. Out of the money. An option that's on the profitable, that's not on the profitable side of the strike price. So the underlying product price is less than or worse than the strike price. 1200 call. The 1200 call is trading at 11.50. The 1200 call is out of the money. It's just the inverse of what we were talking about. 1200 put, if it's trading at 12.50 or more, the 1200 put is out of the money. I've put these in, so hopefully they make a bit more sense, and I've tried to build a little model for you so you've got it. The same deal as we were talking about the calls. At the money. An at the money put or call is one where you buy the strike that's at the equivalent to the underlying product price. So beans are trading at 12.50 and you buy a 12.50 put or a 12.50 call. You would think the market's going up if you bought a call, going down if you bought a put. So your product's trading at 1200. God, I should review these slides. You would purchase your put or call at a strike of 1200. Yes, so if you've bought, if the beans were trading at $9 and you bought a $1,200 call, once the market reaches 1200, the price of the option will move at the same value as the underlying product. Okay, so if you bought, say you paid 200 for the option and it's trading at 500, it's worth 500 when we get there because of time, it's got a long way to go. Every point it will be worth $50 more. So long as the time is not eroding the premium. So if you've got lots of time to go on the option, they intrinsically move at $50 a point. Right. The further in the money an option is, the more expensive. So if you're buying something that's deep in the money, say beans are trading at $9, if you buy $9 or $8.50 calls, you're going to pay more for them. They're in the money. They already have value. They are already progressing at $50 a point.
Why would you want to do that? Because you're buying time?
I wouldn't want to do that at all. Someone might have a view as to why you would do that.
Yeah.
Wouldn't be me necessarily. Yeah.
At the moment, why would you do that?
Yeah. Yeah.
It doesn't make sense.
No.
No.
You buy the physical.
They buy the futures. Yeah.
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 Well, I think you have to remember that most people out there believe that you can have no idea of what direction
Yep.
the market's going in. So they're protecting themselves because they lack knowledge of what might happen.
Yeah, that's true, Tim. Tim makes a very good point that the average punter out there, you are in the minority. I hate to tell you, you are a minority. And most people out there don't believe that you can have any idea which direction the market's going to go. Most people out there tell you you've got to trade price, but they don't believe they know which direction it's going to go. I don't know how that works. I mean, to me, it just seems like a completely diametrically opposed commentary. But you know, I meet people from time to time, and you show them these things, repeating these cycles, repeating. They go, "Oh no, you can't do that," but it did, and it does. So sometimes you can't. Sometimes you can't budge people who have that view. But I think that, Richard, is probably the reason. Like, they don't believe you know where it's going, so they buy something there, and they're picking up the very small increment on the way through.
They might do it as a hedge or to avoid a taxable event.
Yeah, David makes the point that they could do it, you know, to protect themselves against tax or, you know, some sort of hedge. Yeah. But I think, once again, for our discussion here this week, I don't really want to get too much into that stuff. Only because I'm trying to keep it simple, and I'm trying to add just a layer of potential opportunity rather than trying to protect 50 cents. We do that with stops. I mean, we're protecting our position by running stops in the futures market, and we're protecting our option positions by not buying options at $3,500 a piece. We're going to go look at for stuff that's a couple of $100 away out in the distance. The longer the time to run, the more expensive the option will be. You're paying for time. You're paying for the opportunity that it's likely to get there. It's kind of like, I always think it's a bit of a rip-off. You know, there's always someone trying to chisel you somewhere. And you go, well, hang on, I believe it's going to go here. Then they go, well, you know, that's a lot of time for you to be right. Like, we're going to charge you more. That's kind of like, well, it's not really fair, but that's how life is. Value of each option, at the money options, I think of this as par, if you like. It's an option that's trading at the same price as the underlying. Further out of the money, the cheaper the option will be, depending on time. So we're going to look at an option chain. This is what they look like. Have you all seen these? Are we all, yeah, pretty messy. That's one from Saxo. How many of you are using the Saxo platform or PropX? Quite a few, I think. Craig's going to be here tomorrow, and he's going to talk a little bit about the Greeks for you, just to kind of educate you. But this is what an option chain looks like on the Saxo platform. I think that's the E-mini. So this is the top of the option chain. I just wanted to kind of show you what these things are worth, introductory. So this is the underlying month, November. This is a November put. I think it was beans or something. I don't know what market it was. That's the underlying price. So that's where the market's trading right now. So it is beans. It's $14.76 and a half. $14.76 and a half. Number of days to expiry, 121. The expiry date. So there's not much use buying this option that expires on October 21 if you don't think you're going to get to your price by October 21. In fact, it's no good buying this option if the only way you would buy this option is if you thought you were going to be at your target price in September or earlier, 30 days before expiry. Does that make sense? So you don't have to go fish this stuff out. It's on the top of these option chains all the time. It's all there. That's the implied volatility, which we're not going to get into right now. Sorry, that's the volatility. The implied volatility shift is here. Interest rate, the interest value of the options here. We don't really want to spend too much time on that today. These are the things that we're really kind of interested in, with volatility just kind of hanging around. But these are the four at the top are the most important for us. So I put this together as I kind of was trying to tie it all together for you. So if we're at the money down here at say 14.20 or something, I can't read that off my screen there. Yeah, that's it. So if we're trading at the money in here, a put is going to be out of the money down here. In the money. So it's exactly what was on the other slides. It's just been, I got those around the wrong way. Oh no, sorry, I've got them around the right way. One of the things with CQG that plays with my head, it's one of the things that does annoy me, is that you can't change the direction of the chain. So you're kind of left looking at it the way they think about it, and I think about numbers a little differently. I just think about them in a different order. So I put these things together for you so you can kind of see them graphically. So at the money here, a call is going to be out of the money if it's below the strike, in the money above the strike. Volume on the right.
Say like at 16.6, 550 for the premium, the 14.23, is that volume?
No, that's actually the price. Yep. I'll pull up a live one in a second, have a look. A call option that allows you to purchase one bean contract at 1200 until November 21 will be called a November 1200 call. That's the terminology. If you're using CQG, the syntax is C for call. Who's using CQG? A couple of you? C for call, ZSE for beans, X for November, 21 for the year, and 1200, 12,000 for the price. 12,000 is made up of 1,200 for the dollars, and then the extra zero is the quarter of a dollar. So C's for call, November. It's important to know these things. You will see them, understand your own platform and the syntax they use, because it does vary from platform to platform. You can trade them on futures, agriculture's indices, crude, gold, etc. Stocks or bond futures. Options are available on all of them. I think there's even SPY options.
I think so, but I don't think they have any volume.
Probably don't have any volume. Yeah, that's probably a problem. Size does matter. All options are not. Yes.
What's the currencies?
You can trade them on currency too. Yeah. Yep. I never have, but you can. Size does matter. All options aren't the same size. An option on stocks controls 100 shares. An option on a futures contract, an option on a commodity controls 1 futures contract. Just be worth knowing if you're trading options on stocks. It's called a November call as it relates to the November bean contract, but it will expire the month before. So if you think, oh, I'll just go buy a November bean contract, a November call, remember it expires the month before. It's a bit like crude oil. You're always a month ahead of the contract. It's a bit of a mind meld. So when you're putting your quick math together about what contract you want to buy, you need to be aware that they expire the month before. So you need to add another 30 days to the time frame. And this becomes really important when to buy the correct month basis your analysis. If you expect the strike to be reached in November, this product's no good unless you're buying in or at the money, which we've said is not really what we want to do. If you expect your strike to be reached in September or early October, it would probably work. Stock options. A stock option are priced per share, but in lots of 100. So if Acme is priced at $7.25, it'll cost you $725 for the option. It's just slightly different, 100 shares per parcel. Generally, they expire on the 3rd Friday of the calendar month. Share options are generally month to month. So which month? How are we going? It's easy to see which contract you may need to trade if you're looking at the option chain like this. You can see the expiry is right across here. Now remember, we're going to do our analysis before we come to look to what we're going to trade. We're going to do our analysis and figure out where we think the top or the bottom is going to come, and what we think the price will be, and which strikes we want to look at. We need to do that piece of work before we even think about what we're going to try and trade. We need an idea of time and price. We could use form reading, could be looking for a double top or a double bottom, for example. We could have a forecast like our bean forecast over here, or a simple swing setup for shorter term moves. You know, if you've got a simple swing type setup and you have a projection that it's going to do 50% of the previous range or something, if that's what you do, you could actually use that as the criteria to set up an option trade. The only reason I would be interested in doing that is if the risk was less than trading the futures contract or the underlying stock. Otherwise, I don't see there's much point in it. And this is where we start to use all the things I've loosely talked about in workshops and in the supply and demand letter. The other tools, you know, what other tools do you think might be useful? Any other tools we could use? Maybe time, forecast, ranges, previous ranges repeating, square of 9, define price and time alignments. So what do we buy? This is where I differ from just about everybody I've read. Most books talk about buying in the money or at the money. I'm going to talk about buying out of the money, often way out of the money. Market's trading at $4.50, I want to buy a $15 call. Market's trading at $12, I want to buy a $28 call. I'm looking for these big moves in these forecasts to really capitalise on. I might get one of these trades every 12 to 18 months. In any one market. Serious ones. Long time between drinks. Hence, I keep banging away with the mechanical system. Now, if you're trading 3 markets, actually before I go there, I will just say this is one of the reasons, this is where you need to know one market very, very well. You can bang away with a mechanical system on 5 markets like I do in the newsletter and I do myself, and I trade bonds as well and other things. But if you want to do this sort of work, you need to know your market very, very well. That would be my suggestion. Otherwise, become a stripper, and that's a whole different set of rules. You can just go and basically what you're trying to do is grab as much premium as you can based on the form and what you think is going to happen. You know, if the market's in a downtrend and you can take some premium, maybe it's 2 days into what looks like a 7-day move, and you can take the premium and it expires, put it in your pocket. That's a different set of rules again. But if you're going to do any of this sort of trading, you need to have a pretty good idea what the market's going to do. So if you don't know one market really well, I would suggest this is probably the catalyst to go and spend a little time in one market, like crude or beans or wheat or whatever kind of turns you on, whatever blows your skirt up. So I'm going to be talking about buying out of the money options. Beans trading at 16.50 in July, out of a 9.40 low. And I believe, based on my research, they're going to make a top there, and I have a forecast for a low in September. I'll be looking to buy puts expiring in November at, say, $13. What I think I might do before I go into this any further, maybe we should stop and have a cup of coffee and then come back and we'll have a look at the physical examples. Does that make sense? Yeah. Thanks, guys. Look, I hope it hasn't been too confusing. As I said, I haven't done any of this sort of presentation before, so see how we go. Go and grab a cup of coffee and we'll come back and bat on.